I'm here today. I want to kind of just cut through the confusion and let's break down why, personally, I don't really see us heading towards a housing bubble or a crash like 2008. If you feel overwhelmed about the real estate market and really not sure where to start, well, you've come to the right place. I'm Austin Evans with Aspire Realty Group. What's happening, guys? I'm Austin Evans with Aspire Realty Group. And today, I really want to talk about the question that really is on everyone's minds, which is, are we in a housing bubble very similar to 2008? Now, with the constant negative headlines and press that you probably are reading on a daily basis about the housing market, where it's headed, there can be a lot of confusion out there about really, are we headed that way? What's going on? Well, I'm here today. I want to kind of just cut through the confusion and let's break down why, personally, I don't really see us heading towards a housing bubble or a crash like 2008. And I want to break that down and really discuss three key fundamentals that I look at that really tell me that we are not headed for that bubble or crash. The first one really is the low supply of homes for sale versus 2008 surplus we had. So a recent study came out by the Mortgage Brokers Association where they talked about the amount of homes that we have for sale right now in the market compared to the amount of buyers we have. And right now in the United States, we are roughly 3.4 million homes short to satisfy the active buyer requirement we have. 3.4 million. Guys, that's a whole lot of homes out there, okay? So when you look at that, compared with we have currently, if no one else came to the market, no more new buyers hit, we have enough buyers right now to last us through 2025. So we're talking 3 years of pent-up buyer demand right now, but yet we don't have enough homes for sale to satisfy that. When you compare that to what was going on leading up to 2008, we had a surplus of homes for sale. We were in what's called a buyer's market, whereas today we're sitting in a seller's market. Before I go any further, let me kind of break that down because you've probably heard we're in a seller's market or we're not in a buyer's market, but no one's really defined what that actually means. So when as realtors, we look at the amount of homes available for sale out there, we look at how many months supply of homes are available before they would run out. So let's break it down. So let's say right now we have a 6-month supply of homes for sale in the market. What that means that if no other new homes hit the market for sale, let's say we cut it off, stop today, it would take 6 months based on the amount of buyers we have before we run out of houses for sale. Now, 6 months is about a neutral market. When you go beyond 6 months, let's say you have 10 months supply of homes for sale, we're in a buyer's market. When we are under that 6 months, you are in a seller's market. Right now, Freddie Mac came out with a recent study about this topic in particular, and nationally we are sitting at around the 2-month supply of homes for sale. So that puts us deep into a seller's market. And this really goes to one of probably the key basic principles of economics, which is the law of supply and demand. Basically, all that says is this: when you have a low supply of something and a high demand, that's going to cause the price of that good or service to slowly go up. Whereas vice versa, if it was flipped, you had a lot of supply but low demand, that price is going to drop a little bit. Well, right now in our housing market, because we have such low supply of homes for sale, and a lot of buyers, which I'm going to touch on here in a minute, a lot of buyers out there, that's what's driving up those home prices and those home values coming up. There are a lot of buyers out there. Now, going back to 2008, there was a high demand, but we also had a high surplus of homes. We were well over that 6-month supply mark. So when you compare the two, they're not apples to apples. And so that first fundamental really tells me we're not headed for another bubble like we saw in 2008. Now, the second one, and I kind of touched on it a minute ago, was the pent up buyer demand. So right now, you heard me mention earlier, we have enough buyers active in the market right now to last us through 2025. Again, a 3-year span. There are a lot of buyers. But let's back up and go, okay, Austin, so where are all these buyers coming from? Because it's like they just came out of the woodwork in the last 2 years. Well, they kind of did. So the probably the largest demographic currently in our country, the millennial generation, are entering home buying for the very first time. Recent census back in 2020 pegged the millennial generation at around 72 million individuals in the United States. That puts the millennial generation, and I'm one of them, I'm a millennial, we are the largest current generation alive today. You combine that with millennials make up roughly 37% of active home buyers today. So over a quarter of current home buyers on the market is just one generation, and that generation happens to be the largest generation per capita. So when you have all these buyers coming out, you've got just a feeding frenzy of people who they want to buy a home. Now the question is though, why are they coming now versus maybe a couple years ago? Well, there are a couple things in particular. The first one is they're trying to beat rising interest rates. Now, you don't need me to tell you that we've seen some record low interest rates in the last 2 years. I can remember I had a client get a 2% interest rate a year and a half ago. I mean, 2% is just crazy. Now, interest rates are on the rise and will probably continue to rise through this year, where at the beginning of 2022, you were looking at around a 3.5% interest rate with your mortgage. Whereas now we're up over 5% with, guys, to be honest, the expectation is interest rates can probably hit 6 to 6.5% by the end of 2022. So with that said, a lot of those buyers out there are going, hey, I need to get in a house now because the longer I wait, the more it's gonna cost me. Now, on top of that, you've got a lot of these millennial home buyers who are entering the home buying process for the very first time. They have been renting, and they are now trying to beat the rising rent environment. Get this, guys, for the first time in our country's history, for the majority of the United States, the average rent is higher than the average mortgage price, or mortgage payment. Think about that for a second. Again, the average rent is higher than the average mortgage payment for the majority of the United States. And with that said, rents are rising year over year and sometimes hundreds of dollars every year when they go up. A lot of buyers out there are just fed up with it. They are done paying ridiculous rents and want to go build some equity in their own home. So when you combine those two things, that's where all these buyers are really just coming from, and they're coming fast, they're pre-qualified and ready to buy. Now, in 2008, we did have a lot of buyers, but again, the scenario, like I mentioned earlier, there were a lot more homes available for sale than there were today. So those two things are, again, two key fundamentals I'm looking at that really tell me I don't believe we are in a bubble. And last, guys, the third key fundamental I really look at, and personally, I feel this is probably the strongest fundamental and the biggest change from the years leading into 2008, which is the mortgage industry has really just shifted and changed, where there are stricter regulations on the mortgage industry today than there were in 2008. Going back to 2008 and the years leading up to it, this wasn't every lender or every bank, but a lot of them, you could just walk into the bank and say, Mr. or Mrs. Banker, I want to buy a home. I want to get pre-approved for a mortgage. They slide over the application, you fill it out. Where it says your employer and your income, you could really put whatever you wanted, and they were blindly approving those mortgages. So someone who's making minimum wage could have gotten approved for a $500,000 loan just because they said they made more money than they do on their paper. A lot of banks out there were just trying to push these applications through and were not doing their due diligence. When you combine that with the fact of what lenders will do, and this is a little kind of behind the scenes so you can kind of see what actually happens. Once you get pre-approved for a mortgage, you buy a home, you close on the home, The lender or the bank, they don't generally keep that mortgage in-house. What they do is they turn around and resell it to investors in what's called the secondary market, aka think Wall Street or the stock market. So they're reselling these loans with the hope that you don't foreclose, you don't not make your payments on your mortgage, and those investors get a pool of investors to put money into it, and everyone makes money, everyone's happy until it doesn't work. Well, what happened in 2008 was exactly that. You had a bunch of these mortgages that got put into our stock market that all of a sudden people couldn't make their house payment, and then they got foreclosed on. And then another one and another one, and it just created this avalanche of foreclosures. And then all of a sudden, the markets just react, and voila, we have a 2008 recession, which is exactly what happened. Fast forward to today, Fannie Mae and Freddie Mac, who are the housing authority figureheads, and they went into a room, sat down, and said, okay, we can't have this happen again. What do we need to change? And out of those meetings came the stricter regulations that you see today, where you have minimum credit scores that you have to meet. They are doing very extensive underwriting and background checks for you as a potential home buyer. So if you make $50,000 a year, they're going to check that you truly make $50,000 a year by looking at your pay stubs. They're looking at your bank statements. They're looking at how much cash you have saving put away. They really want to know that you are truthfully saying what you are saying. And there are new laws in place that are trying to prevent what happened in 2008. So this third fundamental of the stricter mortgage regulations is really the key fundamental that I take away as the biggest difference between 2008 and now, and why I don't think we are in a housing bubble. So if you have more questions, or maybe you want to learn more about comparing the 2008 housing market to today's real estate market, or you just want to learn more about real estate in general, then hit that subscribe button, like, share this page, and visit my website, and feel free to reach out anytime. I'd love to talk.